Today, we're cracking open a really fascinating business case study. We're looking at Tesla and the absolutely critical crossroads it's facing in China, the biggest and, you could argue, the toughest auto market in the entire world. This is a story about a giant, a titan, facing a decision that could really define its next chapter.
The fortress is under siege. That's a powerful quote, right? And it comes directly from the source material for this analysis. It wasn't that long ago that Tesla seemed completely untouchable in China. So what on earth happened? How did the walls of that fortress even begin to show cracks?
All right, here's how we're going to break this down. First, we'll look back at just how incredibly successful Tesla was in China, the building of their fortress. Then, we're going to get into the sudden collapse of its market share. From there, we'll dig into the core problem, this impossible choice between profit and sales volume. And finally, we'll lay out the two very different paths Tesla can take, and that's where you come in.
So let's set the stage. For years, Tesla's operation in China wasn't just doing well, it was a legitimate triumph. Giga Shanghai was the crown jewel, and honestly, the envy of the entire auto industry.
And this is the secret sauce. Giga Shanghai was more than a factory, it was a strategic weapon. Think about it. They built a 95% local supply chain. That gave them absolutely massive cost advantages, which they then used to just dominate the market. It was a masterclass.
And this is what that dominance looked like. As recently as 2024, Tesla was the #3 EV brand in all of China. #3. They were a giant. Hold on to that number because it's about to change dramatically.
But that amazing position of strength, it just vanished. And it happened with a speed that was pretty shocking. This is where we see the fortress walls start to crumble.
Okay, just look at this. This chart tells the whole story. From being #3 in 2024, Tesla has absolutely plummeted to 11th place just a year later. Now, this isn't just a small dip. This is a complete freefall out of the top 10 in the most important electric vehicle market on the planet.
And the numbers behind that fall are just brutal. While Tesla's year-over-year sales dropped by almost 36%, local competitors like XPeng saw their sales explode by 182%. So the market itself isn't shrinking, just Tesla's slice of the pie is.
So who's doing this? Well, it's a whole wave of homegrown champions. Companies like XPeng and even the tech giant Xiaomi. They're not just making cheap knockoffs. They're rolling out really impressive, high-tech EVs that go right after the Model Y, but at a much lower price. The competition is smart, it's fierce, and it's local.
All of this intense competition has pushed Tesla into a classic and very painful strategic dilemma. It's a fight between protecting their profits and chasing sales volume. And right now, they're caught right between a rock and a hard place.
Let's just define what we mean by that. A strategic squeeze is basically a business nightmare. It's when any move you make to fix one huge problem, like your sales tanking, actually makes another huge problem, like your profitability, even worse. There are no easy answers.
And here's why this is so tricky for them right now. Tesla can't just slash prices in China to win back market share, a play they've run before. Why not? Because their global earnings are already down over 20%. The company's financial armor has some serious chinks in it.
So, this is it. This is the heart of the matter, what you could call the Tesla trap. Look at the two options here. On one hand, they could lower prices. Sure, that might boost sales in China and help them fight back. But it would absolutely destroy their already weak global profit margins. Okay, so on the other hand, they could hold prices steady. That protects their global profits. But, as we've already seen, their sales in China will just keep collapsing, and they risk becoming a tiny niche player.
This trap forces a huge decision. And it's not just about pricing anymore. This is about redefining the entire purpose of Giga Shanghai, one of their most important assets in the world.
So the choice really boils down to two fundamentally different strategies, two very clear paths. Do you go all in on winning the volume game, or do you pull back and protect your profits at all costs? Let's unpack option one. Go for volume. This means you dive right back into that brutal price war. You fight tooth and nail for every bit of market share. And here's the trade-off. You have to be willing to take a major, very painful hit to your company's global profits.
Now for option two. Prioritize profit. This is a total strategic pivot.
You basically give up on winning the domestic market share battle in China. You hold your prices firm, and you transform Giga Shanghai from a factory for China into a high-margin export hub that serves other places like Europe or the rest of Asia.
So now it's over to you. You've seen the data, you understand the squeeze they're in. If you were in charge, if you were making the call, what would you do?
Let's just put the trade-off in the starkest possible terms one last time. Do you risk your global financial health to win the local fight in the world's most important market? Or do you risk becoming irrelevant in that market in order to protect your global profits? As you can see, there is no easy, perfect answer here.
This deep dive was based on the case study Tesla's China Crossroads by Strategy Reloaded, and it's shared under a Creative Commons license. Thanks so much for joining us for this analysis.